Good day, everyone. Welcome to our webinar, Catalyzing Success, Guiding Clients During the RRSP Season and Beyond. My name is Marie Muldowney. I'm the Managing Director at CSI, a Moody's Analytics company. Thank you for joining our webinar today. It was designed to focus on RRSPs and retirement planning. When planning their retirements, and clients entrust their money to our financial institutions and make a real commitment, and often far ahead of their retirement. So retirement provisions require a long-term commitment and need to be planned in conjunction with all of the other options that the client has for their money. The purpose of today's webinar is to look at the options that clients have for their RRSPs, as well as approaches that advisors can take to ensure that clients plan their retirement wisely. So let's begin with a land acknowledgement. So Canada, where this webinar is situated on the traditional territorial lands of many First Nations, Inuit, and Métis peoples. These are places that have long served as sites of meeting and exchange. We recognize and respect the traditional custodians of the lands on which and the waters around which we meet today. So just a few housekeeping items. Today's webinar is being recorded. Any ratings, financial reports, analysis, projections, or other observations as part of the information provided are and must be construed solely as statements of fact and not statements of opinion and not statements of fact or recommendations to sell, purchase, or hold any securities. We ask that no one record this webinar without Moody's explicit written permission. And lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. In addition, the views and opinions expressed or referred to by our speakers are solely those of the speakers and not the views, opinions, policies, or positions of the Canadian Securities Institute or Moody's Analytics or the employers of the speakers. All members of the audience are currently on mute. If you have a question, please type it in the Q&A box on the lower right-hand side of your screen. So with that, let's start talking about this webinar. So we're in the middle of RRSP season. Today's session will be moderated by Rui Barreto. He's Director of Business Development. Rui has been a product specialist at CSI and is a long tenure at a major financial institution as both a lender and financial planner. I'm also pleased to introduce our panelists. Jacqueline Power is Assistant Vice President, Tax and Estate Planning at Mackenzie Investments. Jacqueline brings a deep expertise on the technical aspects of RRSPs, and she also works with advisors to address their tax and estate planning requirements. Joshua Wong is Investment Sales Manager at HSBC Global Asset Management. He works with advisors to help guide them in their approach to clients. Joshua is an expert in relationship management, sales training, investment training, as well as financial planning and wealth management. Joshua works closely with over 130 advisors to help strengthen their capabilities and deliver exceptional financial services advice to their clients. So let me turn the session over to Rui.
Thank you, Marie, and welcome everyone to today's seminar, where we will explore the importance of registered retirement savings plans in shaping the financial well-being of clients. In an era marked by economic uncertainties and changing retirement landscapes, RRSPs continue to emerge as a crucial tool for securing a stable and comfortable retirement. Given that RRSPs are long-term commitment, clients need to be reminded of the value they provide in the future. Disciplined long-term savings is a key focus. Furthermore, RRSPs offer a diversified range of investment options, from stocks to bonds, fostering capital growth while minimizing risk. This diversity creates a robust financial foundation for retirement, shielding individuals from uncertainties of economic fluctuations. Today, we will dive into how RRSPs provide flexibility in retirement income and how this strategic approach allows individuals to structure goals towards their financial needs while maintaining tax efficiencies, both in the present and future. In essence, contributing to RRSPs goes beyond just tax benefits. They serve as a fundamental component of long-term financial security. Let's explore the simplicity of power of the RRSP, together gaining insight to help your clients make informed decisions for a resilient financial future. Jacqueline, can you help walk us through the benefits of our RRSPs? Next slide, please.
Thank you. Thanks so much, Rui. So for some of you, this may be a review, but I always feel it's very good to start with the basics and help everybody understand what the benefits of RRSPs are. So the first thing is that any contributions that your clients make to an RSP, they will receive a tax deduction for that. So that will reduce their taxable income and help from a tax perspective. Now, the great thing with RSPs is that this money is able to grow within the account on a tax-deferred basis. It's only at the time that that money is actually withdrawn, either from an RRSP or from a RIF, that it would be taxable at that point in time. And it would be fully taxable as income. So that's definitely something that your clients need to be aware of as they're planning and going through this process. Now, the nice thing as well is as soon as your clients start to earn income, they're starting to generate RSP contribution room. And they don't need to use that in, the following year. They are able to carry that contribution room forward indefinitely. So that allows them to plan for the future. Maybe their incomes are lower right now, so they don't need to make those RSP contributions right away. This allows them to start to accumulate that contribution room over time. Another thing to consider as well is even after your clients do make that contribution to the RSP, they don't have to claim that deduction in the year that that contribution is made. They are able to carry that forward as well. Another great thing with the RSP is that if you have a client who is maybe hoping to purchase a new home, maybe they qualify as a first-time home buyer, they would be able to, if they qualify, withdraw up to $35,000 out of their RSP that they can use to purchase a first home. And now they would have to pay that back. So starting in the second year after that withdrawal is made, they do need to start repaying those amounts into their RSP, and those repayments would happen over a 15-year period. But it's great because it does allow the client to have this additional money available to them to be able to hopefully, put a down payment on a home. And if they have a spouse who is also considered to be a first-time home buyer, then in that situation, they would each be able to take $35,000 out of their RSPs. So all of a sudden, they have $70,000 that's available to them for that first home purchase. Now, another great thing with the RSP is maybe your clients are thinking about going back to post-secondary. They want to pull some money out of their RSP in order to be able to do that. So they're able to pull out a maximum of $20,000. In any given year, they can pull out $10,000 and have that go towards their post-secondary education or that of their spouse or common law partner. Now, they wouldn't be able to pull money out in order for their children to attend post-secondary. In that sort of a situation, they would do more planning through RESPs rather than making those withdrawals through an RRSP. Next slide, please. So some of the potential goals that your clients may have surrounding RSPs, I think first and foremost, a lot of Canadians are looking for tax savings. And that is where the RSP can be really quite beneficial because any contributions that your clients are making into that RSP, as I said, that becomes a deduction and that would reduce their taxable income and as a result, reduce those their tax bill for that particular year. Now, there is a tax liability, as I mentioned previously, that would happen, and that's at the time that they withdraw that money from the account. But the idea is that they are having this tax savings now when they're in a higher tax bracket than at retirement, when theoretically they would be in that lower tax bracket. Now, another reason why people would want to save within RSPs is to save for retirement. Years ago, a lot of employers offered defined benefit pension plans or defined contribution pension plans. That is not nearly as common as it once was. So as a result, Canadians need to save for themselves with your help. And that's why RSPs can be really quite beneficial to them because it allows them to have this retirement income available to them when they are ready to retire. Because if they're just going to focus on, CPP or OAS, that is not going to be enough money for them to survive. They have to have other sources of income as well. And RSPs are a great source of income for those individuals. Next slide, please. So succession planning is also something that you definitely need to discuss with your clients and something that they need to look into. So if your clients have a spouse, generally they would want their spouse to be the beneficiary of their registered accounts because the spouse is able to inherit those on a tax deferred basis. So it would only be at the time that that second spouse passes away that tax liability would apply. Now, when your clients pass away, if they don't have a spouse or if they're the second spouse to pass, then in that situation, that RSP is going to be fully taxable as income within their terminal return. So this can translate into a large tax liability. And it's really important to make sure that you and your clients are planning for that tax liability. Maybe there's insurance money that pays into the estate that can be used to cover that liability. Or maybe there are other assets within the estate. Something to be very much aware of is for many years we had been told, defer, take the minimum amount that you can out of these registered accounts. Try to hold off on taking that money out as long as possible. But now with our high tax rates, if you have a client who's in the top marginal tax rate, that's going to be 53.53% that is going to apply as far as tax is concerned. So it may not make as much sense for a client to defer. You really need to look at each client on an individual basis. I came across a gentleman a few years ago, and essentially he had $1.5 million in his RSP and didn't have any other assets. Essentially what had happened was he and his wife had been saving in RSPs. That was the only vehicle that they used. When she passed away, he rolled the full value of her RSP into his RSP to save that tax. And then he had said to me, he's like, well, now my sons are going to inherit this account when I pass away. So I want to take as little out of this account as I can so that they'll each have $750,000 available to them. Well, you can imagine how surprised he was when I explained to him, because of the value of that RSP, that's going to be taxed at 53.53%. The tax liability was over $800,000. So instead of each son receiving about $750,000, each was going to receive about $350,000. So then it opens up the conversation about, well, maybe it makes sense instead of taking out the minimum to take out more amounts. Another thing to consider, not for this client, but for other clients, is when that first spouse passes away, does it make sense to roll the full amount to the surviving spouse? Maybe a portion of that RSP should be taxable in that first spouse's terminal return, so that tax liability is happening there instead of all applying to one particular spouse. Another thing that you need to make sure that you're encouraging your clients to do is review beneficiary designations. If they've recently become married, have them review it. If there's been a divorce, if somebody has passed away, it is very important to make sure that you are reviewing those beneficiary designations. Next slide, please. So now what I wanted to do is talk a little bit about spousal RRSPs, because these can be an excellent tool for your clients and a great way for them to be able to contribute to their spouse's RRSP. So generally where we find this works best is in situations where there's a higher income earning spouse, and essentially they would make contributions to the lower income earning spouse's spousal RRSP. In that situation, the contributor receives the deduction for that, and then the annuitant has these contributions that are going into this account for them over time. Now, the annuitant, that lower income earning spouse, they are the ones who own that account. So all direction with respect to that account would be taken from the annuitant and not from the contributor of the account. Now, in the event that your client maybe were to go through a marriage breakdown, in that situation, the value of the account belongs to the annuitant. So when that equalization calculation is being done, it is going to consider that to be an asset of the annuitant and not of the contributor. Now, one thing that's really important to be aware of when we're talking about spousal RSPs is attribution. This is something that not everybody is aware of. And essentially what happens is if somebody goes to withdraw from an RSP and a contribution had been made to that RSP in the year of the withdrawal or the 2 preceding years, then essentially that income is going to attribute to the contributor and be taxed in the hands of the contributor rather than being taxed in the hands of the annuitant. So that is very important to make sure that your clients are aware of that. Another thing to keep in mind is with respect to the RIF. So once that spousal RSP is converted to a spousal RIF, if the annuitant is pulling out the minimum RIF amount, there would be no attribution that would apply in that situation. But any amounts greater than that minimum amount, if there had been contributions that had been made to the RSP in the year of that RIF withdrawal or the 2 preceding years, then any amounts greater than that minimum amount, that income would attribute back to the contributor. So very important that your clients are aware of this as they start making withdrawals from the account. Now, again, in the event of a marriage breakdown, attribution stops at that point. So in that situation, the annuitant could make withdrawals from the account and it would not be attributed to that contributor due to the marriage breakdown. So those are the points that I wanted to cover today as far as RSPs are concerned. Now I'd like to pass it back over to Rui.
Thank you, Jacqueline. Everything that Jacqueline has actually pointed out is linked to a strategy that oftentimes clients may not find as important. RSPs tend to be a long-term focus, something that they don't see, touch, or feel until later on in their lives. Given that we're going into the month of February and RSP contributions are a key factor in that tax savings space, the only thing I would kind of say is make sure you're including a lot of that stuff that Jacqueline has actually mentioned in your conversations. Clients are often running into your firms. They're making a deposit, putting the money into a savings account for a future decision on where they want to invest it. Just remind them that there are strategies that you can work with them on in order to ensure that the goal of this contribution is going to be met in the long term. With that being said, engaging with clients is extremely important at this time of year. And so what I'd like to do is transfer this next section over to Joshua, our panelist, to kind of talk you through some of the key questions that you should engage clients on.
Okay, Rui, thank you very much. And excited to be here to speak to everyone during RSP season, very timely webinar. So I've got a couple of questions that I'm going to walk through with you on the topic of dealing with clients to maximize potential in RSPs. Now, there's just 2 good questions here. How do you utilize RSPs to optimize your financial planning and retirement savings? And there's also another question: how confident do you feel about your own retirement? Now, these would be great questions you could ask your client directly, but I think the approach that I'm going to take today is to think about, what have you done for yourself? Now, have you asked these questions to yourself? Because once you've taken care of these 2 questions for yourself, it's going to be a lot more easy to help your own clients. Now, when I think back to when I was an advisor, RSP contributions were something that I did for my clients. However, as I progressed through my career, I realized that RSP contributions are just, one part of it. And it's quite different from actually doing retirement planning. And obviously with the education from CSI, getting my PFP, using financial tools such as, retirement calculators, compound interest calculators, that really helped me understand the impact of making contributions to my actual retirement. So my suggestion here is that what you want to do, if you haven't done it already, is obviously, get more familiar with the benefits of retirement planning, do your PFP, et cetera. But from there, definitely pick up some of the tools that your firm may offer or the ones that are free online and play with them, practice with them, do some financial plans for yourself, and really, change up the assumptions, whether it's the contribution amount that you're using every year, the number of years that you're going to work for, the investment return assumptions, make them higher, make them lower, factor in any one-offs that could happen, such as inheritances, and you will likely, open your eyes to the fact that you either have, a great situation and you feel very confident about your retirement potential, or you might find a shortfall. But you also realize at the same time that there's still time to make adjustments the earlier you figure this out. And so, taking this back and this experience and then working with clients, you will find it much more effective to be able to communicate the benefits of RSPs and obviously retirement planning for your clients. Next slide, please. Okay, the next question is, how do you engage with clients who are actively contributing to their RSPs, but haven't really considered moving other investments to you? And again, we've got some questions here that are very helpful. But before I go into that, I want to talk about, there's a lot of information that you probably read online or you've talked with other advisors. There's a lot of benefits about consolidating assets with one advisor. For example, you keep it simple for your clients instead of having to manage, multiple advisors, multiple accounts. They can do it all in one place. It saves them a lot of time. There's a potential for lowering fees when you consolidate, balances with multiple institutions with one. You reduce the risk of overlap in investments and also the lack of coordination between advisors, because advisors tend to not talk to the other advisors due to confidentiality reasons. Now, those are well-documented benefits of consolidating, but I want to talk about something a little bit different. I want to talk about client experience. I think at the end of the day, what's very important in consolidating assets and getting your advisor to choose you as their key trusted advisor is the client experience. This could be and usually is the key differentiating factor. So when we talk about client experience, it's important to ask yourself, when it comes to having positive experiences, what really resonated with you in your everyday life. For example, you went to a hotel and you were really impressed by the way they treated you, or you've gone to a nice restaurant where you've had tremendous service, a wonderful experience on a birthday, for example, or a corporate event or an industry event. What stood out for you? Was it the personalization that they did? Was it the attentiveness to your needs? Was it the professionalism? Was it the care? Was it the gift that you got at the end? What was it? And then taking that approach into your own practice and thinking about how you can enhance the experience for your clients that are dealing with you, in addition to all the financial aspects that you're going to be working with. How can you personalize the experience for them? How can you be more present in the meeting with them? How can you be a better listener? How can you understand them better? How can you be more professional? How can you be more caring to their needs? And how can you make the meetings more enjoyable and more sort of a collaboration rather than you doing all the talking and them doing all the listening? Now, if you're having trouble coming up with some ideas in terms of how to enhance their client experience, there is this interesting principle that came from Charlie Munger that I read last year. He mentioned it's called inversion, and it basically means you want to do the opposite. So his example is tell me where I will die, and I will be sure never to go there. So obviously that's a joke, but in reality, the way we would apply this is tell me all the things that I should avoid to create a poor client experience, and if I avoid all of those, then I will likely produce a good client experience for your client. So there's a strategy that you can apply if you're having difficulty coming up with ways that you've been impressed with excellent client experience. But I would say, through your daily life, you should be coming into contact with lots of great client experiences. Take some notes and see how you can implement that into your own practice. Next slide, please. All right, the next question is, how can you strategically leverage the RSP season to expand your book of clients? I think this is a great question. All of us want to help more clients, help other clients, help the clients of help the friends and contacts of our clients. This is going to piggyback off of the previous question about client experience. When in your life, when you've had great client experience, you typically will share that with many people. For example, if you read a really good book and it really changed you, you're going to talk to everyone about this great book. When you've been to a fantastic restaurant to celebrate a birthday, or for example, you're going to tell people how wonderful that restaurant experience was. Or if you've been on a vacation and it was just fantastic, a great memory, you're going to tell everyone. Or if you got a good deal on some clothes or whatever it is, you're going to talk to people. Recently I've had a great personal trainer that I started with, and obviously I've been telling all my friends about this great experience. So when you have implemented, a great experience for your clients, in regards to saving for their retirement, helping them really identify that they're going to be able to retire on time, or for example, if they have a shortfall in retirement, but you've given them real actionable options to help them, bridge that gap, they're going to want to share that experience with their friends and family. They're going to have a lot of friends and family that are going to be in a similar life stage with them, or going through a similar situation. We know that, in today's sort of world that we're living in, there's so much financial news and hacks on how to save more or how to spend less. There's a lot of information out there, but it is quite generic and it's not personalized. So the real value that, as an advisor you can add is helping your clients to navigate through all the different things. So when you're a great resource to help your clients understand what tips and advice can apply to them directly and help their cause or help their retirement, then you really truly add value for them. And that's where you can ask them for introductions to their friends and family to help them, or the other approach is to get feedback. One of the important things is asking your clients, how was the experience? What did I do well? What type of advice did I give you that gave you today that added a lot of value, that made you feel comfortable? Document that as well, and build on that. And areas where you thought you did a great job, but the client never really brought it up, perhaps you can change up your approach. But again, remember, when you ask for an introduction, there's always the hesitancy from the client about sharing client information, obviously. So you want to make sure that when you ask for an introduction or you ask for a referral, you remind your client that, all, what's happening, all their personal information or financial information, their situation is all confidential, so they feel a little bit more comfortable. Next slide, please. And my last slide here is what are some soft skills essential to managing a client's financial goals, especially when it impacts their future? I think this is a great question. I think, at RRSP season, it's obviously a captive audience here. People are aware they need to make their RRSP contributions. And so if you're going to contact them, they're likely going to be, available and interested to meeting with you. But that might not happen, after the deadline, because they're going to be busy with other parts of their life. So one of the ways to really connect with your clients to talk about retirement is to sort of handle the different things in their life that they're going through where they need financial advice. And once you sort of help them with that situation, then you can talk about retirement, which is, a very, very big and important thing that's really far away and not really as apparent in their current situation. So, giving an example is, if you've had a client who's had a life event where they've had a child, definitely help them, obviously talk to them about all the great things about having a child. And obviously, if you've had a child before, you can also share stories, tips, etc. Gradually that will transition to talking about setting up RRSPs to help set their children up for the cost of education. But then from there, once you've helped them with the RRSP, then you can go back to helping them with their own retirement, because at the end of the day, we all have multiple financial goals, and we need to take care of all of the different things. We focusing on RRSPs isn't just enough. We have to focus on other areas. Another potential situation, for example, if there's a lot of market volatility, this would be a good time to reach out to your clients, talk to your clients about market volatility, how they're feeling, and then obviously reassure them that market volatility tends to be short term, and it doesn't really have a significant impact on their long-term retirement plans. And again, that sort of redirects the conversation back to the long term and back to retirement and how we can review, how their plan is working. In the last couple of years, the dramatic rise in interest rates is affecting a lot of clients that are that have a lot of lending, mortgages, variable rate mortgages in particular. So again, they're very focused on whether interest rates are going up. They're going to be focused on how their mortgage payments are increasing or maybe increasing. And once you've dealt with that conversation, help them with their cash flow, help them with, prioritizing, their different payments, etc. From there, again, what's left over for retirement savings contributions, what's left over for retirement, and then the conversation can move towards retirement planning again. So just some ideas here that you obviously have to help with clients' retirement, but it may, after RSP season, it may come from helping them with different things that are on the client's mind at this point in time. And then last but not least, I just wanted to touch on one thing about, calendar management and appointment times. I know when we're starting out as advisors, we kind of get set in a default setting appointments for an hour long, and having sort of one objective for the meeting, and we kind of feel restricted and safer in that environment. However, if you can, appointments don't have to be an hour long, obviously, and if you can finish what you want to achieve in 30 minutes, there's a great way to set up a discussion there on a second topic, right? And ideally, you want to set this up beforehand. You don't want to say, well, we're done now, but can you stay for an extra 30 minutes so we can talk about something else? That might not come across that well for the client, but if you set the expectation at the beginning, perhaps send an agenda ahead of time to the client and sort of say, look, today we want to take care of your retirement contribution, or discuss increasing your retirement contribution amount. And after that, we want to move on to another financial goal, for example, your kids' education, or saving for a down payment, whatever it is. And then you can use the remainder of the appointment to talk about that. And then also, I would say the last tip is, you've seen it with your dentist, but the dentist approach. If you have an appointment today, make sure to take that opportunity to set up the follow-up appointment, whether it's 6 months down the line or 3 months or a year, whatever it is, set up the future appointment. That makes it easier for clients, and it makes it easier for you if you're trying to manage your time better and manage your calendar better. Okay, with that, I'll turn it back to Rui.
Thank you, Joshua. Actually, it's you kind of stole my thunder. I was gonna take that reference back to the dentist, and when you're visiting and you're leaving, there's always that next appointment booked. So something that I implemented when I was on the financial planning side and worked very, very well for me. To your point, I mean, with everything that's going on, the business of everybody's lives, and getting time in a client's calendar to kind of talk about something as important as retirement is often sometimes missed. Clients, again, don't see the benefit of retirement planning or even retirement contributions until they're well into that phase where retirement's getting close. And that's where it becomes that much more important. And having those conversations today, when they are contributing and they're a little bit younger and leading into retirement, becomes that key focus on how you kind of secure the business and secure your clients. This is not something new, and I think you've said a lot of it, but there's nothing wrong with asking a client where there's been a great experience to ask for a referral. If you want to compliment me, you want to give me something as a token of the service that you felt that I provided, there's nothing more important than a referral. So thank you, Joshua, for everything that you've highlighted on the importance of practice management and applying all these great techniques in your clients' engagements. I do have some questions. So what I'm going to do is I'm going to direct the questions to either Jacqueline, Joshua, or both, and we'll go through them together and see how many we can get through. Those that we can't get through, we will respond after the webinar and follow up. My first question is going to be for both of you. Because RSPs are tax refund, and it's deferred taxation and not permanent tax reduction, how do you have a conversation, or do you find that most clients, when they withdraw money from their RSPs, they're using it for more expenses such as trips, entertainment, and not so much the focus of retirement? And Jacqueline, I'll start with you.
So I think it depends. I think there are lots of situations where people are waiting and they're not making withdrawals out of their RSPs until it is time for retirement. But right now, people are stretched thin, and I think a lot of Canadians right now are making withdrawals out of their RSPs. And I unfortunately, my guess would be there's going to be quite a surprise to many individuals, whether they made withdrawals in 2023 and they're going to notice that when they file their taxes this year. Or if this is going to affect them when they file, 2024's taxes. But as I sort of alluded to in my presentation, I don't think a lot of Canadians realize that this is taxed as income, and that when you make these withdrawals, that is being added to your income. So I think, at different times, I think it's less that people would be making these withdrawals. But right now, I think because people are trying to pay their mortgages, trying to, just survive, that I think that it is very likely that there are more contributions that are being made from RSPs than we would have seen, 3 or 4 years ago.
And Joshua, same question, but I guess from the perspective of having those conversations with clients, and when should you have them? Should they be sooner or as they get closer to retirement, on how these refunds should, or sorry, how these withdrawals should be approached in a discussion?
Yeah, that's a good point. I think from an advisor practice management point of view, you want to be touching base with your clients regularly. So the sooner you have these conversations, the better, because the sooner you have the conversation, the more options are available to you. And I would say the other point is that things change every year. Financial situations may change. Interest rates go up, interest rates go down, deductions get put into, new deductions come on, new income splitting rules, et cetera. There's things that can change. And so when you're meeting with your clients on a regular basis, especially ones that are getting closer and closer to retirement, there are a lot of things you can look at, including even the investment vehicle that they're in. Is it time to change it up because they're getting close to needing to withdraw it? So yeah, I would say sooner the better. And obviously look at all facets of that discussion, including the type of investment you're in, the economic environment that you're in, and your personal circumstances.
Joshua, this next question is for Jacqueline. So for an RRSP, what happens when the high income contributor has maxed out their RRSP contributions, and what options would they have as a result of this?
So once they've maxed out their RSP contributions, they are not able to make additional RSP contributions until the following year when they have additional earned income. Now, we do have a $2,000 buffer, if you will. The government will allow us to go $2,000, and this is a lifetime limit over that RSP contribution limit. But there are penalties if individuals go over that limit. So essentially, the penalty is 1% per month that individuals are in an over contribution position. So generally, you want to make sure that your clients are not going into that over contribution position, and have them instead just wait. So when a client is looking at their contribution room, if they're making spousal RSP contributions as well as individual contributions, both of those are counting against their limit. Also, if they happen to have a group RSP at work, that is also factoring in. So it's really important to make sure that you're having conversations with your clients about all of the RSPs that they're making contributions to ensure that they don't go over that limit.
Thank you. Rui, can I just add a comment onto that? It just reminds me, Jacqueline, your answer is excellent, and it just reminds me to that section that I had about consolidation, right? At the end of the day, if you have all these different RSP plans that are happening, if some of them are automated, if some of them are sort of manual, you really run the risk of over contributing or under contributing because you thought you were contributing in the other plan. So that's one of the key benefits for consolidating with one advisor, is to make sure that someone is on top of all your RSP accounts, and you can go to for history of how much you've done and how much you need to top up, for example. I would say RSPs are one vehicle to save for retirement. We don't want to forget about tax-free savings accounts and even non-registered accounts. At the end of the day, if you've maxed out your RSPs, then you've maxed them out. However, that shouldn't stop you from saving for retirement. The tax-free savings account is great. The limit's higher this year. And obviously non-registered is also a great savings vehicle as well. Thanks.
Thank you. This next question is a little bit long. I'm going to direct it to both of you, starting with Joshua. The question is, I have a tough time recommending RRSPs to clients who are in those lower tax brackets. Do you think RRSP room would be better kept for years where a pension is realized, for example, or the higher income earning years, the last 5 to 10 years of work? And the individual's actually going on to say, how do I use TFSAs or FHSAs in non-registered investment vehicles as compared to those in the RRSP? So I think it's a two-part question. I think from a technical perspective, Jacqueline, that's something that falls to you. But Joshua, from a conversation with the client, how would you kind of address all of these options that are in the marketplace when a client comes and presents that to you?
Yeah, that's a great question, and definitely I'm going to defer to Jacqueline on the technical side for sure. But I think at the end of the day, what this speaks of a client that is quite knowledgeable and is quite in tune with all the different types of accounts, and they're trying to really figure out which account type or which strategy is going to fit them best. So I think that's, first off, kudos to that client, right, for doing all this research and being in tune with the account types. I think at the end of the day, there's a lot of assumptions being made, right? There's you're not earning a super high income today. You're assuming there's, and we don't know how far down the road this is. This could be 30 years later, 20 years later in retirement. You think you won't be, earning a high income at that time. It's hard to know. So I think, obviously, working with someone, an advisor that, can talk you through the pros and cons of various strategies. Where do you think your life situation is going to be today? Where do you think you're going to have higher income in the future? How much unused room you have in your tax-free savings account, in your FHSA, which is pretty brand new. What are your goals? Will you need to make withdrawals out for a home buyer's plan or lifelong learning? So I think there's a lot of things. I think the first step, is to just sort of educate or at least work with the client and understand the different account types, the pros and cons of each. Then maybe from there, sort of try to map out the client's sort of life journey, where are the key milestones, and then try to figure out the best vehicle for that. But I'm going to really defer to Jacqueline on this one, because I think she's definitely better suited to answer.
Thanks, Joshua. I agree with everything that you just said. It really does depend on every situation. If you have clients who, to Joshua's point, are interested in doing a home buyer's withdrawal, well, they need to have money in their RRSP, and it needs to be in there at least 90 days before that withdrawal is done. So in those situations, they may want to be making RRSP contributions. But if it's a younger Canadian who is just getting started, in many situations, they don't need that deduction right away. So to the point, as far as, maxing out on the TFSA, that's what you want your clients to be doing first and foremost, because it is a tax-free account. So if they don't need the deduction, then that's where they're going to want to be putting that money instead. But it really depends on their situation. I wish I could say, this is what they need to do. If they anticipate, like you'd asked about the pension, if they do anticipate, receiving a defined benefit pension plan, and when those contributions are made, a lot of those defined benefit pension plans will use up all of the contribution room for a particular year. So if somebody is having contributions made to that DB plan, but they still want to be able to make RRSP contributions, if they have had this amount accumulated, then that's great. But that's the crystal ball, right? Most people don't know what their next job is going to be, or where they're going to be, and whether they're going to be offered a defined benefit pension plan. And that's why it's really important to look at each client individually. Look at the moment and see, in this particular situation, how, could they benefit from that deduction? If they could, then it would make sense to make that RRSP contribution. And that might be a time to, partner up with an accountant, so that the accountant can, also give a good sense for when that might make sense.
Thank you. All great points. This next question, again, I will direct it to both of you, again, from a different perspective from each. Jacqueline, I'm going to start with you, and this is more of a technical part of the question is, oftentimes RSPs are set up at a young age. Most people will open up an RRSP at the age of 18. They've been employed. They now set up an account. They list a beneficiary. Life happens. They get married, and the beneficiaries often don't get updated. How does that kind of impact an individual should they pass away and the beneficiary is, for example, their father versus their spouse? What is the technical impact as a result of that setup?
Yes, that's a great question, and it would go to the father. It would not go to the spouse. So that is something. That was why it is so important to make sure that your beneficiaries are updated. I have one that's even more impactful as far as an issue that can arise, and that is with respect to marriage breakdown. So I have come across situations where they forgot to update beneficiary designations, have a new spouse. Former spouse is the one who's the beneficiary on the RSP. And what happens is that RSP pays out fully to the former spouse, like no withholding tax applies, but the tax liability is within the terminal return. So essentially the new spouse is the one who's having the tax issue, and the former spouse is the one who's getting the proceeds of that account. That is something that we definitely encounter, not on a regular basis, but we do encounter that. So you really need to make sure that you're encouraging your clients to be reviewing beneficiary designations anytime that there's some sort of a change in their circumstances. Even if there are no changes in circumstances, I would recommend reviewing it just the way they would review wills, which is supposed to be every 3 to 5 years.
And Joshua, I guess the question to you is what does that conversation look like? Obviously, life stages and life changes. How would you recommend approaching that?
Yeah, that's great point from Jacqueline's, and I'm going to again bring it back to having multiple advisors and multiple RSP accounts, and having the potential risk of different beneficiary designations. So really, it's super important to help your clients understand that less is more. Keeping it simple is very, very valuable. And you might have had an RSP account set up 10, 20 years ago. It's such a small amount, and now it's grown, and the beneficiary designation or the beneficiary is set up for someone that was important in your life 20 years ago and is no longer even talking with you, and you've forgotten about that. So I think with RSPs specifically, you want to make sure you have the right beneficiary because of some of the rollover benefits for spouses. And you also want to make sure, and because RSPs inherently grow over time, you want to make sure that things are allocated. So yeah, I think the will review is a good time to also review your beneficiaries for all your investment accounts. That's one way to do it. But I think it's a best practice. When you're doing your annual review or whatever it is your review, make sure you confirm the beneficiary. And you might be surprised that the client says, "Oh, well, thanks for bringing that up because I've just had a life event and now, I want it to be my son or my daughter or whatever it is." Yeah, I think it's super important and very sometimes it's missed by a lot of clients.
Thank you, Joshua. Jacqueline, this question is a technical question, and I think it resonates with where we are in the calendar here. February tends to be that RSP season. Clients come in and they make their contributions, and then that seems to be the growing idea of when most of these contributions occur. But we often know that contributions occur throughout the year. So the question is if a client had made a contribution late in the year 2023, they're earning interest, the overcontribution plus the interest has now put them into a bit of a predicament. And the question is can we apply that overcontribution made late in the year towards the 2024 tax season?
So if they had earned income in 2023, then that overcontribution will disappear January 1st of 2024. And if they made that contribution in 2023, they will receive a tax receipt for that that they can use when they file their tax returns in 2023.
And this next question is if you have a client that's a little bit on the older side, again, Jacqueline, to you, and they decide that they want to go back to school, is there an age limit? Example, 65 to 70?
As far as making the lifelong learning withdrawal?
The withdrawal and then a contribution back.
Yeah, so they can make the withdrawal and the contribution up until 71. Now, the withdrawal they would want to do earlier because once the RSP is converted to a RIF, any amounts that had not been paid back as far as that lifelong learning withdrawal, that would count as income to them. So they want to make sure that they're planning for that because so they likely wouldn't want to, I would say, yeah, it would depend on them, but generally, you know, if they do it at 60, and then in that situation, they would have to start repaying at the latest by 65, and hopefully that would they would have to do, you know, faster repayments in order for them to be able to have that fully repaid by 71. But they could do that. As I was saying, otherwise that full amount is going to be included as income after 71.
Yeah. Joshua, this question is for you. With anxiety running high among clients today, not just for retirement, but also in the current state of buying mortgage or buying homes, mortgages, and whatnot, how do conversations between planners and advisors in preparing for the future kind of occur, or what would that look like?
Yeah, Rui, this is one we get a lot every day, right? This is the, there's a theory about saving for retirement, but then there's the reality about, surviving on a daily basis, right? Or having to take care of goals that creep up, So I think, obviously retirement is an important conversation. We will get to that, or we will have to talk about that. But what's immediately are the needs that the clients are facing. So these days, as I was talking about in my presentation, these days it's a lot is around cash flow because of higher mortgage payments or the potential for higher mortgage payments coming down the road, or is it inflation and really the cost of living being important. One of the benefits of using the financial calculator, especially the compound interest calculators, you can really see how a $50 contribution or a $100 contribution per month compounded for 10, 20, 30 years, is such a huge amount. And I think that's what we can do to sort of help our clients understand that, what can you afford today? What can you, at the end of the day, retirement is going to be something that you're going to need. It's something that if you defer, it doesn't really help you, achieve your retirement. It might make you feel a little bit more free on your day to day and more comfortable. And I totally understand and appreciate that. But at the end of the day, you can, if you're starting early, that's the best thing. And even doing, a small amount, what you can afford, can really help, start you off in a good situation. And then when your finances become a little bit better, maybe you get a raise, you get a new job, or maybe interest rates come down, or maybe you have a significant other to share the costs. At that time, you can, revisit increasing your contributions. But pay yourself first is a really good approach, obviously. But paying yourself first, and then you sort of deal with what you have after that, and then you can sort of figure out your finances. I think we're all in this boat. In the last couple of years have been quite challenging for everyone in terms of higher costs, and we've all had to find tips to save on certain expenses, manage the cash flow better. And I think those are real conversations that clients will see a lot of value in, and maybe helping with these conversations first, and then transitioning to sort of bridging to retirement is probably going to be more effective than just hammering retirement, and they're thinking about today. Yeah. Jacqueline, obviously I'm not the moderator here, but I would like I'm not as an expert on this piece, but can you just talk about that? There's a benefit out there of perhaps doing an RSP loan, and then with the refund you can pay off the loan. Can you maybe talk about that? Because I think that's kind of where I was also wanting to go.
Most definitely. So RSP loans are great. Now you would have to look right now and see, with the interest rates being higher, whether it does make sense right now or not. When interest rates are quite low, it definitely makes a lot of sense, because essentially what happens is that there's this loan that is made, and that money that is borrowed goes into the RSP, which then creates a deduction for the individual. They get that refund back, and then they can either use a portion or all of that refund to pay off the loan or to start to pay off the loan. Or they could put that money into, say, a tax-free savings account and then be able to have this money be growing tax-free. So definitely in certain circumstances, it makes a lot of sense. As I said, right now with interest rates, you would have to look and see whether now is the best time. But that refund can be quite powerful because a lot of the time these are large amounts that end up being contributed to that account. And a lot of people are able to start paying off that loan really quite quickly at rates that they otherwise wouldn't be able to. So it is definitely something worth looking into for sure.
And the last question, and I'm going to direct it to both of you. A client who has an outside pension, and Joshua, you said earlier that it does make sense for a single advisor to beneficially manage a lot of the strategy for an individual's retirement. When it comes to a pension plan and the pension plan is with one firm, does it often make sense to move it to an advisor's portfolio? And if so, when would be the best time? Closer to retirement or in advance of retirement at an earlier age is, I think, the question. And that's, again, technical. Joshua, Jacqueline, whoever wants to jump in on that one.
Jacqueline, if you want to go first, that's
For sure. Most definitely. A lot of the time you cannot transfer that to an advisor, especially if it's a defined benefit pension plan, because that is going to that's one of the criteria is that it needs to stay within there. Same thing, even if it's a defined contribution pension plan, a lot of the time you can't move it until you leave employment. And then when you do leave employment, with a DB plan, if they happen to take the commuted value, most definitely that can 100% be transferred to the advisor. It is, if they've chosen and it makes sense for them to take that commuted value, it definitely makes sense to consolidate that with all the other assets. Defined contribution, they could definitely take that wherever they wanted. But at the time that they are still employed, they are limited. Most of the time, they're not able to move those assets.
Yeah, I'm not going to do a follow-up on that because I think you answered it very well. So I'm going to pass it back to you, Rui.
And with that, I'll turn it over to Marie to close us out.
Or take us off mute, it'll be much better. Listen, thank you very much for your points of view, for your advice, Jacqueline and Joshua. I think it's been a great session in terms of giving us lots of information, lots of perspectives, lots of things to think about in terms of both the technical aspects of RRSPs and the various instruments that we have out there to help our clients save, and at the same time, the kind of advice to give to advisors in order for them to best advise their clients. Obviously, one of the key messages that comes through here is putting your client's interests first. And it's much easier to do that when you have a consolidated groups of accounts. But if you don't, you really have to make your clients think about what kinds of actions that they are taking. So the recording of this this webinar will be made available shortly. We'll send it out. If you have any questions with respect to the webinar or anything else, you can write CSI at designations@csi.ca. Obviously, you can go to our website. We're always interested in furthering people's careers, starting with the CSC or the IFC, and then moving on to credentials that you can get throughout your life in the financial services industry. So thank you very much to both our speakers. Thank you, Rui, for animating the session, for moderating, and we wish you a great day. Thank you so much for attending.